The Federal Reserve is expected to hike rates once again in a move to battle rising inflation. Many analysts are predicting an increase of 3/4 of a percentage point, but some say the Fed could go as far as raising the rate by a full percentage point. So I want to bring in John Leer to talk a little bit more about the impact that we could see from another rate increase. He's the chief economist at Morning Consult. Thank you so much for joining us again. So I know this is sort of basic, but can you just remind us of the relationship between inflation and interest rates?
Sure. So in general, as interest rates rise, that tends to constrict the economy and makes it more expensive for folks to borrow money. And that in turn leads to sort of a slowing in the economy, and that tends to bring inflation down. So that's how it's supposed to work in theory.
And then what will be sort of the most notable difference in our everyday life if interest rates continue to go up?
I think there are a couple things. So the biggest thing will be later in the year, we should expect to see slowing job growth, probably some more layoffs, less investment. And that's really the result of a lot of the work that the Federal Reserve did earlier on in the year to try to get inflation under control. It takes about 6 to 8 months really for those interest rate hikes to work their way through the economy. So that's the biggest thing. And I think, for folks who have outstanding credit card debt, maybe that's with a variable interest rate, they'll also experience that in terms of higher interest payments.
So is it inevitable that if the economy slows, which is what the Fed is hoping to do, that there will be people who lose their jobs?
I think so, unfortunately. I mean, I think the Fed is really trying to avoid that outcome, but we got to remember where we are right now in terms of the labor market. We've got an extremely tight labor market, very, very low unemployment, high levels of job switching, pretty high levels of wage growth. And so I think the aim is basically to slow down or take some of the air out of the labor market without going too crazy. And that's really the challenge or the trade-off that the Federal Reserve faces right now.
So, here's the thing about the Fed and the rate hikes. The Fed has been had warned us for months almost beforehand that this is coming and there would be several. And we have seen them, but still the economy continues to run hot. What's different now versus sort of other times where raising the interest rate seemed to help to slow things down? Or is it what you're saying, which is that we haven't seen the impact of the initial rate hikes yet, but we will see them later on?
I think it's a little bit of both. So it does take a while. The other thing to note is just that we were starting from very, very low interest rates, in particular when you start thinking about so-called real interest rates. So that's not only, if you've got a 1% interest rate and a 4% inflation rate, then all of a sudden real rates are actually negative. And so it's going to take a lot for the Federal Reserve to get closer to the so-called neutral rate, where it's neither sort of driving the economy further nor slowing things down. So I think that's probably the biggest point. And then maybe the other point I would note is just that it is going to take a little bit of time, that we've had some external factors, I think, that have worked against the Federal Reserve. In particular, I'm thinking about slowdowns in China and the war in Ukraine. A lot of those sort of supply side shocks have made it particularly challenging for the Fed to get inflation under control.
Yeah, that makes a lot of sense. John Leer, thank you so much.
My pleasure.